Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm happy to be hosting this week's topic, which is titled, Keep Your Guard Up. Now, our goal here at VectorVest, and for me specifically in retirement services, is to not only help you build a portfolio of safe, quality companies, but also to help you manage that portfolio once it's built. And that includes being prepared to protect and preserve your capital when needed. First, here are some previous special presentation dates that address the topic of protecting profits and preserving capital. We revisited the 10 tactics for a strategic defense of your portfolio. Did that back in December of 2016. My colleague Glenn Tompkins revisited that once again on November 17th of 2017. And then on December 15th, we had capital preservation in the VectorVest system. So just some videos if you wanted to go back and get some more information on this topic. So why now? Well, there are some conflicting ideas and points of view out on the market currently that are out there that can become very confusing and lead to uncertainty. And we know the markets do not like uncertainty. For instance, there are headlines from two of the most successful hedge fund managers ever really out there right now, along with Goldman Sachs. David Tepper has been cutting his stock market holdings, the headline reads. Ray Dalio talks about a recipe for a nasty downturn, though to be clear, Mr. Dalio does not look at that in the short term, but what may be on the horizon. But this information, again, out there, these type of headlines can be cause for concern. But not to worry, because VectorVest has the information you need to make the best decisions. Now, I'm sure you guys remember the classic movie Wall Street and the famous or infamous protagonist, Mr. Gordon Gekko. Now, there were a lot of great quotes in that movie, but the one that always stuck with me is when he told Bud Fox, and he said, "Buddy, the most valuable commodity I know of is information." Now, VectorVest provides information that you need to know when and how to protect your retirement nest egg. And some of the most valuable pieces of that information are found in the climate section of the VectorVest Views every Friday evening. Let's go ahead and take a look. The first thing I'm going to do is take us into the home page and go to the main toolbar and take us into the Views tab. And here we have, as we do every Monday through Thursday, the timing section. However, every Friday evening, if I go back to September 7th, gives us an extended version of the weekly newsletter. And it gives us all types of information, the overview, Dr. DeLito's essay, as well as strategy and climate sections. For now, what I want to do is click on the All tab and take it right down to the climate section of the VectorVest Friday evening views. And here it begins with just an overview of current economic conditions and indicators. And then down below, as we scroll down, we see our composite of investment climate indicators here on the table. And it's here we check each week where our current market scenario is. Now, currently we have a case for bull market scenario in which earnings, inflation, and interest rates are rising. You can go to VectorVest Views from these dates here to get more information on the truth chart, and we also have graphs of the VectorVest investment climate indicators by clicking on graphs on the main toolbar and then clicking on market climate graphs. So the key here, as it relates to a conversation I had with Dr. DeLito earlier this week, again reinforcing the idea of how important earnings are to the overall market. And so I just want to be clear that today's topic is not about predicting or foreseeing some drastic downturn in the market. It's just being prepared at strategic times to help protect your retirement nest egg. So as long as earnings are rising, we will remain in that bull market scenario. And we can see that first here on the table down below when we look at the S&P 500 earnings. The average earnings of the S&P 500 is $5.76 as of Friday, September 7th's climate table. And it shows week by week the earnings trend indicator using the VectorVest climate indicators closed on the 7th at 1.18. So that's above 1 and has risen week over week. So earnings are still rising, and that's going to be the dominant factor that dictates where the market will head over time. But that doesn't mean there can't be some potholes or hurdles along the way. If I go to the Graphs tab and I click on the drop-down arrow here, I can take us into the market climate graph. And here I've got it set to up top the S&P 500 earnings. Again, we said they were $5.76 as of last Friday's close. Here we have the S&P earnings trend indicator, which closed at 1.18 last Friday. And then finally on the bottom I have the S&P 500 index, and this is roughly a 2-year look back at the market, and you can see once again the correlation between the movement of the market along with the earnings trends, and it's no coincidence that as earnings continue to rise, so too do the markets. But again, we do need to keep our guard up. Next, I'm going to go ahead and take us into a market timing graph and illustrate one example on why it's important to know when to be proactive, again, and protect and preserve our capital. So if I look at an end of day 1-year graph of the market timing graph, or the VectorVest composite, we've got it laid out here in candlesticks with the MTI buy-sell ratio and RT down below. What I'd like to do is just add support and resistance here to try to make the point of how and when we need to be careful. And so if I go back to January the 26th of this year, we see a market that had taken off. What happened here is that at that time we had hit an all-time high on the VectorVest composite. So what I want to do is go to the Views tab and take us back to that date. In January was the 26th, which was a Friday, when the VectorVest composite hit that all-time high. Next, I'm going to click the drop-down arrow and take us to the strategy section. And here is where that commodity called information comes into play. This is just one example of how you can minimize losses and get through those severe drawdowns with just 1 or 2 very basic, very easy steps. So we come to the strategy section. Had we read the views that Friday night, we could read through, see how the market had performed. But then as we read through, Dr. D wrote that night, even though the market was rallying, let's not get carried away. And he noted that whenever the percentage of sells is as low as it is now, and on that date, this buy-sell ratio had the sells down below 8%. In other words, there were very few sell-rated stocks in the market. And at that level, he stated there's usually a pullback. So enjoy the rally, but continue to be careful. Down below it says prudent investors may buy rising stocks in ETF when the market is rising, but don't bet the farm. And here's the key sentence: downside risk exceeds upside potential. Downside risk exceeds upside potential. Now, if I were to have read that information on Friday night or sometime over the weekend, it only makes sense that I would want to be proactive and in some way protect all of those profits that we saw leading up to the end of January in 2018 and somehow lock those in or hedge or buy insurance on those gains that we had looked at. Now, one of the techniques for strategically defending your portfolio is simply understanding how to buy a put option. Now, in this case, we're going to look not on buying puts on an individual stock, but rather on the overall market, or in this case, the S&P 500. What I have here is just a screenshot of what the put side of an option chain for the SPY, or the SPDR ETF. And the SPY is the ETF that tracks the S&P 500. It's a non-leveraged ETF and moves pretty much in unison with the overall S&P 500 index. This is a snapshot of the option chain from the close of trading on January 29th, which would have been that Monday after reading the VectorVest views from Friday, January 26th. The S&P 500 ETF, or the SPY, was trading roughly 284.5, give or take a few pennies here. So the question we often get, what strike price do I go ahead and buy when I'm using the SPY puts as insurance? And as we'll talk about in a moment, it really depends on how much insurance that you are comfortable with. So with the SPY trading roughly 284.5, the example I'm going to use is the 280 strike. I just want you to think of this as a deductible. This is nothing more than an insurance policy on your overall portfolio. So you could buy the at or in the money strike of 285 or 284.5, and I'll just use the last closing trade as our numbers here, and pay as high as 292 or 312 per share, or $300 roughly per contract. But again, we're looking for insurance, so anywhere from that at the money to out of the money, roughly a $5 increment I would recommend, you can go out and pay less money for your insurance policy. So in this case, if I'm looking at the 280 strike, I'm paying $1.58 or $1.59 here, actually, again, using the closing prices to insure my portfolio. Remember, owning a put option gives you the right to sell SPY at a given price by a certain date. And so the value of that put option rises when the value of the SPY ETF falls. And I'll show an example in just a moment. The next question is, how many put option contracts do I need? So I put together, again, just some quick formulas for portfolio insurance, just a quick layout of how many contracts that you may need. Ultimately, again, that will be up to you on how much defense or insurance you want to purchase. But here, the number of contracts is just based on the value of your portfolio divided by 100 times the put strike that you choose ultimately. For an example, we used a 289 strike price. This is when it's trading a little higher, but you would just insert the current at the money strike. So if you were to do that, $100,000 portfolio with the SPY trading at 289, you would need somewhere between 3 and 4 put contracts to cover your insurance needs. Let's look closer with some filled in numbers. If the Spiders was trading at 289, and theoretically, of course, the SPY were to go to 0, you would have the right to sell that stock at 289. If it were to go to 0, you would make a $28,900 profit on one contract. It tells us I would need roughly 4 contracts to protect that $100,000 portfolio. Again, you'll determine how much insurance you feel comfortable with, but just keep in mind, if you've got a $100,000 portfolio, roughly 3 or 4 contracts will protect it. $200,000, you might want 7 or 8 contracts, and so on. It's just a rough formula to give you an idea of how you can protect your portfolio. Now here I have an example. It's a trade simulation, or a look back, or a back test, if you will, on what would have happened had we heeded the views from the Friday night strategy section and went out and said, you know what, I've got some nice gains in place. It's incumbent upon me to protect those gains. I'm going to be proactive, and based on the fact that I just read that downside risk exceeds upside potential. For my prudent/retirement-minded portfolio, it would have been a great time to say, I'm going to hedge or insure that portfolio by going out and buying some SPY put options. So, in this case, what we would have done simply is go out with, again, SPY was trading around 284.5, give or take an eighth of a point. I used the 280 strike as the example. And I only went out to the expiration of February 17th. That was the next monthly put option expiration. So I like to use the monthly expirations. I don't have to go out long term. Again, it's just an insurance policy for the short term based on market trend indicators were telling us at the time, and what the analysis of that was in the strategy section of the VectorVest Views. So to protect that theoretical $100,000 portfolio, I could have gone out and bought just 3 contracts. The premium would have been, again, we're using that closing price. I used $1.58, which is a cost of only $474. That's the debit, or the cost, not including commissions, of what it would cost me to go out and protect my portfolio. Now, as it turns out, in this case, if I had held that put option to expiration, and again, that's a theoretical scenario I'm setting up, had we held the put option out to expiration and sold it on that date, we would have gotten roughly the intrinsic value, or in this case at the close, premium would have been at least $6.89. Why? Because SPY closed all the way down at 273.11. By buying that 280 strike, the option is now $6.89 in the money. And what that translates to is a better than $1,500 profit over that time frame. Now remember, when we go back to the market timing graph, we did have a pretty severe, although short-lived, downtrend in the market. And so that was a great way to mitigate that risk based on the information at hand. What that did for us is protect that profit as we reached that all-time high on the VectorVest composite. Keep in mind what would have had to happen. Now, if you did nothing there, you would have had to wait till the end of August this year just to get back to where those profits were at this level. Even though the market has been on a very nice uptrend since February of this year, you would have had lost time use of money there, having to live through that drawdown and waiting to get back to that level where you could have protected way back in January. Now, as the VectorVest composite once again tests that support at 48.22 and retraces back towards that 49.03 resistance level, it's just important information to have, and we'll see how the market responds. We'll see how the buy-sell ratio and our other RT and MTI indicators respond as well. But the key is having the information to know when to strategically place that defensive measure, and in this case, the defensive measure calls for buying put options on the SPY, or the ETF that tracks the S&P 500. So remember, we are in a case 4 bull market scenario and earnings are still rising. However, we still want you to be prepared and be ready to keep your guard up when the information tells us it's time to do so. Thank you for taking the time to join us for this week's special presentation.